Okay, thanks. So for those of you that don't know me, I'm Lee Powers. I'm the Director of Operations here at KS Management. We want to do these educational seminars every so often throughout the year. This is our second one this year. We try and do them every year to bring different topics to you guys as board members to help you guys in your roles. So one of the ones that we did last week was with an attorney. This week we're lucky enough to have these two ladies from Farm Bureau here to talk about insurance. So I will turn it over to them, and if anyone on Zoom has any questions, throw it in the chat. Any of you guys just speak up anytime, and there you go.
Thank you. My name is Christy. I'm our Vice President of Sales for the agency, and this is Amy, who is a producer at the agency as well. And today we're just going to talk about some very basic insurance 101, as we call it. If you guys want to get into the weeds, we can, but I'll let you ask those more detailed questions when we get there. So I've been in the insurance industry for about 8 years. Before that, I worked at a no-fault law firm. So I'm very familiar with kind of both sides of the industry. I've worked for Maris Brown now for about 5 years. And I really enjoy doing this and speaking to you guys. So if any questions arise as I go through the presentation, please just feel free to either just give me a little wave or shout your question out, okay? Okay, so we're going to talk about the basics of condominium liability, property, umbrella, D&O, and fidelity bonds. We're also going to briefly touch on some unit owner expectations, what they should be looking out for. I know a lot of board members, or typically almost all board members, live in the community. So this will help you guys with your policies as well, determining what type of coverage you should have. One moment. There we go. Okay, so the first part we're going to discuss is property coverage for your associations. So typically in the standard market, there are two options that you should be aware of and that you should be looking for on your policies. They're blanket coverage, replacement cost, or guaranteed replacement cost. Depending on the carrier, they have two different options. Replacement cost is going to be value without any depreciation, versus where like actual cash value, if you're familiar, is a value minus depreciation. So we never want our buildings to have an ACV or an actual cash value basis. We want to make sure that we're replacing with like, kind, and quality. So blanket coverage, if you have 10 buildings in your association, we take the value of each building. They have their own separate values done with what we call a BVS, or a commercial value estimator. Those buildings are then blanketed together to give you that blanket coverage limit. So that blanket coverage limit allows you to use the entire blanket for a single loss. So if you had one building have a fire and you needed beyond what that building's value was, you would have the full blanket building value to replace that building. So it's very important to blanket coverage. It gives you kind of a buffer for that replacement cost. And then of course, guaranteed replacement cost, it will be like, kind, and quality without what we would call a cap. So if it was a higher value building, you would get that full guaranteed replacement cost regardless of what its actual value was listed at originally. We always want it to be 100% of the replacement value, which we call an agreed value. So this means that you have no co-insurance penalties. And I don't know how familiar you are with insurance, but a co-insurance penalty is essentially, if you cheat us, we cheat you. So if you had co-insurance on your policy and you underinsured your building to, let's say the co-insurance penalty is 80%, okay? You would have to insure your building up to 80% of that co-insurance value. So 80% of its true value, you'd have to go to co-insurance. If you didn't, they would penalize you based on a formula at a percentage of your loss. So if you want agreed value, you do not want co-insurance. It's very difficult, especially in the current market, to evaluate how much your building is worth or what it would cost to replace it. Another thing to look at on the policy, miscellaneous property and business personal property. So communities who have clubhouses, garages, carports, streetlights, mailboxes, mailbox houses. You want to make sure that your policy either includes coverage for these items in the blanket or has a separate rider or endorsement that covers that property. And then of course, your deductible is incredibly important. So as a community, what makes sense for you? You may have a very high reserve fund, a very high annual revenue, and you might be able to afford a higher deductible, which would reduce your insurance premiums on your master policy. However, whenever a loss occurs, you would then have to pay that deductible out after the claim. So you need to evaluate what deductible you can afford as a community. Any questions so far?
So co-insurance and deductible are two different things?
Yes, very different.
Is, in miscellaneous property, is there a difference between an attached or detached garage?
There is, again, every carrier is different, but technically a garage would be part of a building for most carriers, it would be part of the structure. Other carriers, it could be what we call our valuations, it could be separated by the valuation. So it should be part of your total building value if it's an attached garage. You might want to confirm with your agent that they took that into account when they wrote the buildings, depending on what information you gave them. You want to make sure that they know that there are attached garages as part of the property.
Where does damage to the property fit into this? This is replacement. What happens if we just have damage? Somebody drives their car through the.
So the perils are what we call special. So you'll want to have special perils on your property, meaning anything except for what is excluded. So that's going to include a vehicle driving into your building. That's going to include wind or other weather related damage. That's going to include fire. So there's different ways or different perils that you can have on a policy. You always want your policy to carry special perils. It means it includes everything except for what's excluded. If you see basic or broad, that should be alarming to you. Anyone else? So it limits, so instead of having special coverage where everything except for what's excluded is covered, you have very specific coverage items. So basic is the very basics. It's fire, lightning, it will exclude vehicle. It's like 5 very specific coverage items and everything else is excluded. So I could get you a list of exactly what those are, but you want the special perils. You do not want basic or broad perils. So collapse, for example, wouldn't be included due to ice or snow. Okay, there's some very specific optional coverage that every policy, at least in my professional opinion, should have. So we have ordinance or law coverage A, B, and C. So coverage A is going to be loss to the undamaged portion of the building. Coverage B is going to be your increased demolition costs. And then coverage C is going to be increased cost of construction. So I'm going to go through an example and kind of go through each stage so that it's easier for understanding. So imagine that so you have a condominium building. Half the building burns down in a fire. The second half of the building is not damaged. A standard policy only has to indemnify you for what you've lost. So that first half of the building that was damaged is the only portion of the building that would get rebuilt. Now, in most cases, if half a building burns down, you're going to have to knock the entire structure down and start over with the same like, kind, quality, and materials. So coverage A is always going to be to the building limit so that you have the whole second half of the building to replace. Okay, so that's going to replace the undamaged portion of the building. Coverage B is that increased demolition or debris removal cost. So coverage B is going to pay for the debris removal and the demolition of that portion of the building that didn't burn down in the fire. Coverage C is increased cost of construction. So let's say that that building in this scenario is completely demolished. We need to rebuild it, but it's 35,000 square feet, and the city of St. Clair Shores says you must have a sprinkler building at this day and age if you have over 25,000 square feet. and now you have to put sprinklers into this building. The standard policy, again, only has to indemnify you. So they're not going to pay for your increased cost to install sprinklers. So coverage B and C are at a limit, so coverage C, that increased cost to install those sprinklers, is what would pay for that coverage. Okay, so as buildings get older, coverage B and C are more and more important because there's likely been many ordinances or laws that have changed that are going to require new materials or sprinklers or certain types of fire code. Water backup coverage, so this is going to include water backup, sewer, and sump overflow as well. So the first thing, of course, is what limits necessary for your community. Most policies are going to do it on a per building or a per occurrence basis, and then they're going to have an aggregate cap for the policy. So depending on your building size and how many units you have within a building, you have to determine, okay, how much coverage do we need in a water backup event? So if your bylaws require you, say your bylaws require full replacement of the unit, you're going to have very high expenses, right, for a water backup event, because you're going to have to do the carpeting, the interior, and all of the damage to the structure itself. If you have walls in where the unit owner is responsible, you may have a little less cost associated. So size of the building and your bylaws are huge in determining water backup. And then again, the age of the building, because we do see more frequently water backup claims due to roots growing through pipes and that type of situation in the older buildings. Again, what's your responsibility? Check your bylaws, make sure that you're appropriately giving a limit that makes sense for your association. Business income coverage. So this is loss of income. You want to make sure that it also includes extra expenses. So these are expenses that continue even if the association building is lost. So that might include snow removal, that might include the loss of fees that you charge all of your, so let's say the community building, if there's a fee for your association to belong to the community building or to use the community building, you might lose those fees associated with that building. So typically they're written condo policies, most carriers that I'm aware of or that I've seen happen by a number of months. So the standard is 12 months. In order for you to determine how many months or years you need to rebuild, you would have to know, number one, how large is my building? What is the current construction market like? Which right now, rebuilding something in a year is probably not going to happen. So if you can get it, if you can get 24 months business income, this is going to be better than your standard 12-month policy. But keep in mind, so if you have a 12-month policy, right, as soon as the building is built, that coverage stops. So let's say you have a small building and it only took you 8 months, but now you have to find new unit owners because maybe they were tenants, maybe they were renting. At that point, your business income coverage would stop unless you have what is called extended period of indemnity. The extended period of indemnity allows you to continue to collect those dues and to collect those additional expenses and fees into a certain period of time. Typical standard policies are either 60 or 180 days. That may be enough for you. If you can, again, if you can get 360 days or a year, that's going to be your best coverage option. So remember, first, how long is it going to take for the building to be rebuilt? So size is very important. And then second, once it is rebuilt, how much time do we need to either let our unit owners replace what they need to, or get someone new into our building? Any questions on that?
Aren't we obligated to pay the dues?
I mean, depending on your bylaws, yes. So it would be extra expenses at that point.
Is there coverage if someone were to foreclose and stop paying the dues?
It would be a discussion with the adjuster. I would assume in a situation with a foreclosure, most likely not, that would still be on the actual unit owner. But maybe fees.
This just applies to condos, not to units, right?
In what, so are you saying just one unit?
You know, like, this policy you're referring to, this is not for individual standing homes. It's like condos.
That, yes, this would be for,
It's the same.
so it would be for a condominium, so it's
Okay.
where anytime you have business income or revenue. So if you do have, so let's say you have site condos, but you have a community building, you should still have business income coverage for the community building, because that's where your revenue is generated.
I was thinking of attached and detached, but I was thinking.
Oh, yeah, but obviously, if it is an HOA,
Yeah.
they would be responsible for their own loss.
What if the reason it burned down was due to the owner?
Due to the unit owner,
Mm-hmm.
we would, your insurance policy would still replace that building for you. I've seen, oddly enough, recently, some things written into bylaws about, negligence and the unit owner subrogating against. I have personally never seen that in the industry. The insurance company rebuilds your building, that's why you have property coverage and accidents happen.
But wouldn't our insurance company go toward after their insurance company first?
To the unit owner, the unit owner doesn't have coverage for your structure. They only have coverage for their unit. So at the most, what you, again, it would have to be a liability claim, and I have never seen that occur. And I've actually heard this question quite a few times now, and I've never seen there's mutual waiver of subrogation in most bylaws, meaning the unit owner is not responsible and the association is not responsible, and vice versa. You are responsible for only what it says you are responsible for in your bylaws, regardless of the loss. So that mutual, yes, so that mutual waiver of subrogation is where that comes in. Anybody else? Anybody in the chat?
Nope.
Okay, so liability coverage. So we're gearing away from property coverage and we're starting liability coverage. So liability coverage and determining limits. First, you have your general liability policy, which most of you will see as a BOP, or is referred to as a package policy, a business owner's policy. It's going to have property and then the liability. So your general liability limits standard are going to be 1 million, 2 million. Typically, there's a second option for a 2 million, 4 million. And then we have umbrella policies that go over top of those as well. So for my communities, what I always say is, what is your exposure? Is your exposure just general slip and falls, which can be very costly on their own? However, in Michigan, we do have the open and obvious laws, which assist with that. So if you're properly doing snow removal and salting, those are arguable. The biggest concerns are, do you have any increased exposures on your lot? So do you have pools, ponds, exercise equipment, anything on the property that could spark an additional claim or a death is really what would be the most hazardous to you. So if you do have those increased exposures, it's very important to look at your limits and make sure that you're adequately insured. So umbrella policies will go on top of your standard limits. They can go from anywhere from $1 million to 50 million if you needed it. Again, I always look at the size of the community, what's the exposure based on the size of your community and your additional exposures. Something that I see often is that you'll have a D&O policy and it won't be listed underlying on the umbrella. So it's important that you're discussing that with the agent, making sure that if you have an umbrella policy, that your D&O policy is also listed under it, because obviously D&O is arguably the most important thing to everyone in this meeting, making sure that you're adequately insured. Any questions?
What does D&O stand for?
Directors and officers liability. You both have the same question? Yeah. Great. I sometimes forget that I speak in this lingo every day, so for me, it comes naturally.
Can we explain what the usual coverage for D&O insurance is?
Yes, we are going to get to that just a little bit later, but we'll get into the specifics. Okay, so we're going to talk now about coordinating your policies and your coverage based on your bylaws. And then, of course, educating the co-owners in your community on their HO6 or in some cases HO3 policies, depending on what type of community that you have. So, first of all, policies are written according to the bylaws. So you may have, so let's take an example of an interior unit being the responsibility of the co-owner. So you would have what we would call a condominium without interior finishes coverage on your building. So that's gonna replace everything up to that drywall. And then everything inside the unit is going to be the responsibility of the co-owner. So that's your first standard type of policy. The second, of course, is a full condominium policy, where the only thing that the unit owner is responsible for is their personal property, personal liability, loss of use, and there's other factors and other types of coverage that they can have, but those are the general core items. We want to make sure that if you are updating your bylaws, we've been seeing that a lot recently with switching from being full condominium to condominium without interior finishes. If that happens, we have to make sure that we're notifying the unit owners in a manner where everyone is acknowledging that they've accepted those bylaws. We've seen a couple instances recently where people claimed to not have received them, and there have been some fire loss that caused a lot of grief for some unit owners. So make sure that you're really doing your due diligence if you do update those bylaws and make those changes, and that people are acknowledging the acceptance of them. So we're going to get into specifically some unit owner coverage and how to educate your unit owners on what they need. So we always say they need to review their policy with their agent and ensure their coverage is adequate for the bylaws and their specific needs. So everyone always asks me for a rule of thumb, right? And I tell all of my clients, there isn't a rule of thumb. If you have an interior unit that you're responsible for, it could be anywhere from $125 per square foot to $400 per square foot, depending on the finishes that you chose. You could have a fully finished basement that costs you $600,000, and it's got a wet bar and a sauna and a hot tub. And I say that because I've seen one like that recently that had a fire. So you have to make sure that you're going by what your needs are, not what the standard of the industry is. The rule of thumb is only there so that you know, okay, I'm way off base if I'm only at $10,000, right? Personal property, so I always tell my unit owner policy holders to create an inventory of your belongings. But for a general rule of thumb, $400,000 for the first 1,000 square feet, and then $5,000 for every additional 500. And that's just based on market data and, again, standards of living.
Just say 40 or
40. Personal liability, again, so the master association is going to cover all of the common elements. So what you're responsible for as a unit owner is going to be the interior of your unit. Anything that's considered like your deck, for example, would still be part of your responsibility. So let's say there's a slip and fall. Let's say a postal worker walks up to your mailbox and drops the envelope in the mailbox, and it was your responsibility to salt the sidewalk, but it didn't happen. I always say that everyone is getting sued in the events of a claim or liability. They don't care what the bylaws say. Now, it might get thrown out, right? But you're gonna need defense, and you're gonna need to have personal liability coverage. In some instances, if they decide that it's 50-50 liability, you're going to be on the hook for that. So I always say personal liability should be up to whatever your net worth is to adequately protect you for your assets and everything that you have. Obviously, for some of us, if that's $10 million, that might be overkill. However, the rule of thumb for that is what is your net worth and insure to your net worth. Loss of use, so this is one that people overlook often. So this is going to be the cost you incur when you have to relocate. Say you have to live in an apartment or a hotel. You're going to have additional expenses beyond just the cost of living in those places. Pet boarding, storing food. A lot of policies will give you, again, 12 months actual loss sustained. Well, in the current market, it's taking a lot longer than 12 months. So if you can get a policy that gives you a limit, you can increase that limit as you need. And then, of course, loss assessment. So this is loss assessments rising from, so covered claims in the association that exceed your limits. The most common that I've been seeing with this is communities with very high deductibles. So $50,000 deductibles, and a community building has a large loss, they have to foot the bill of the $50,000, and then they assess their entire community for $100 a piece or $100 per unit to replace the deductible. So the loss assessment coverage on your insurance policy will foot that bill for you. They start out typically at $1,000, usually go up to about $75,000. It is pennies on the dollar to have 75,000 instead of 1,000. Now we're talking the difference between $1 and $7 a year. Some specific pitfalls that unit owners miss on their policies. Water backup. Again, there's usually some combination of association responsibility, unit owner responsibility. If that water backup damages the interior of the unit, and that's the responsibility of the unit owner, they need that coverage. A lot of unit owners don't realize that they need that coverage. A lot of unit owner policies will have actual cash value for their personal property. I see it all the time. That should always be replacement cost. If you have pots and pans and outfits in your closet that have been there for 10 years and you have an actual cash value policy, even though you have $50,000 in personal property, if you have actual cash value, you probably won't see a penny of it. Jewelry, fine arts, firearms, electronics, there are limits in most policies to these types of specific coverage. So you might only be able to charge up to $2,500 in jewelry, and you might have grandma's stash that she gave to you when she passed away that's worth $50,000. The only way to insure that type of property is to schedule it on a scheduled personal articles rider. And again, typically it's fairly inexpensive depending on how much coverage you need. Some other things that people kind of lose sight of, precious moments, collectibles, memorabilia. There are going to be limits on your policies for those things. If you have something that's incredibly important to you that has a high market value, you should schedule it. Sentimental value. I get this question very often. Well, my precious moments are worth the world to me. I've had them for 30 years. I could never get the same ones again. So should I insure them? That is, you're never going to get sentimental value for an item. You're only going to get its market value. So that depends on whether you want to pay the insurance to replace those precious moments, or you just realize that that was a sentimental value to you that you can't replace. The example of sentimental value that I always give is, I had a client, it was a commercial client, he had taxidermy in his office. Wasn't scheduled, wasn't insured, he lost all of it. Put a market value on that. You can. Again, loss of rents. So this is specifically for your unit owners that lease. I know we try to put caps on how many people can lease, but if you do have leased units, number one, they need to notify their insurance company that their unit is leased, because if they don't and a claim happens, they won't have any coverage. The loss of their rental value. So if they're renting their condo unit and then they live in a home and that's what pays their mortgage, they're going to want to have their loss of rental value on that policy. Again, you'll only have that if you've properly insured the unit for rental coverage. Any questions on unit owners specifically?
I have a question, more general, I think, about this. What happens if you're in an association and you have a larger number of rental units than you do homeowners?
It can be an underwriting issue for your community. In fact, it will be an underwriting issue. And typically the way an insurance company will handle it, and I'll speak to the ones that I work with specifically, is instead of a condominium policy rating, you'll be rated as an apartment. Because really, for all intents and purposes at that point, that's what you are.
Yeah. a sad situation.
Yes, and it's about double, so if you have a 10-cent rate on your condo, you're probably gonna have a 20 to 25-cent rate on your apartment.
Right, they become less mortgageable.
Yes.
What if, is there coverage in your standard policy for the association that would cover if a unit owner wasn't properly covered? Like, let's say our association covers, of course, rebuilding the entire building of 4 units if unit A burns down, kitchen fire, cigarette, whatever. They didn't keep their insurance up to date, so they can't, there's no money to fix that, and how it impacts the
The rest of the
tiny units.
units.
Yeah, because of the burn, the smell, and not being replaced. Is there anything for that food situation?
There is not, and that is one of the detriments to it having a condo insured, or the bylaws written that way.
Right.
So
Managing properly to make sure you get the insurance proof.
yes.
Proof of insurance.
And it's very difficult because you might get an insurance proof at the beginning of every year. And you wanna, so something that I would tell you is you can get what's called a 30-day notice of cancellation from every carrier. I would recommend that every unit owner that you get a copy of their policy, that you ask for that 30-day notice of cancellation.
Or require it or whatever.
Yeah,
So that
require
the
it,
insurer knows to notify you.
exactly,
Right, because it's like the people get insurance for their car and they drop it as soon as they get the insurance.
precisely.
Mhm.
And again, so when you're
So someone
evaluating,
struggling or, yeah, doesn't manage their own money or on the verge of foreclosure or something.
Yes.
so unfortunately, yes, that's just a detriment to having those that type of bylaw situation.
And managing.
Yes, and managing
Yeah.
your certs.
Real quick, so back to Dick's question, so if you've got somebody renting their unit, and the renter does not have that insurance, would it be reasonable to have the owner have that insurance?
So, again, I would be very specific with this in your bylaws for what you require. But what I recommend is that the unit owner has to carry the dwelling coverage if it's required. And then the renter would only have personal property
Good.
coverage.
That's also my problem.
Yeah, that
Yes,
seems like that would be.
yes. And then they can build that into their lease, the cost of their insurance. If that's what they're, if they have an issue with that, that's what I would say is build it into your lease. Anyone else?
What about dogs, and dog bites and that sort of thing?
Be
How does that impact insurance rates and coverage?
So master policies, it's not going to affect you, it would affect a unit owner, so it would be considered their personal liability for their animal. So in the event of a dog bite claim, that would affect their insurance. It
So
really
one of
wouldn't affect
the person who got bit said the HOA didn't properly,
Vet or list
try to make them keep their dog leashed, or try,
Sure.
because everybody gets roped in when there's a lawsuit, right?
Yeah, like I
So-
mentioned earlier,
Right, so when you get a renter or a homeowner that just habitually doesn't follow the rules, pushes the limits or whatever, and an accident happens, which I know we had with fair housing with renters, and
oh,
I
sure.
knew somebody who had a renter that was playing loud music, and eventually there was a lawsuit, and they tried to blame the association for not making the renter
Mhm,
keep it down, like just the triangle, the ugly god awful triangle.
sure,
Dog bite, I would think could be the same thing, if they said, you knew the dog was off the leash, you didn't do anything.
sure. And as long as you as an associate or a board are sending the proper notice to them, you're violating the bylaws, you're violating written notice,
Written notice.
verbal notice. Every way you can possibly notify them that they're doing something that is against the bylaws and the rules of your community will help you in that lawsuit.
Okay,
It'll help you win that lawsuit, or
or not be held responsible.
precisely,
Versus
or
the owner of
negligent,
the dog.
correct.
Okay. And what about like the condition of the parking lot, potholes, vehicle damage, aside from slip and falls? Is there liability for that sort of thing? Or coverage for that?
Well, I mean, it would be whoever, whatever their auto carrier's their auto carrier would have to pay for that
Which
loss.
typically doesn't come.
They
out of that.
They could, what doesn't,
The-
damage to their vehicle?
Right,
I've
like my
never,
own coverage would cover that, right?
if you damage, I
If
mean,
you were driving, if you were a guest at somebody's parking lot to visit a unit owner and hit a pothole and jack your car up, can they make a claim against the HOA?
so your policy comprehensive coverage would cover you in that claim.
Okay.
They could try to subrogate against you if they wanted to,
Just wondered,
but yeah, your auto coverage should cover you for
meaning the HOA's coverage.
the personal vehicle that was damaged
Yeah, they're
policy.
Oh, okay.
You should have drove around.
Have you seen it?
Now, last time, I was here,
It's the same thing.
KS, I was leaving, and when I did the turnaround there, there's so much water, I didn't know there was a hole there. And there must have been a key in there. No sooner did I start going down North Line, going west, my air pressure went from like, 30 down to 1. And I pulled into the gas station there, and there's a key sticking out this long, like an old Ford key.
Oh.
Yeah, so you don't know, there's water in, I didn't know there was a pothole there.
Yeah, I just
Oh,
That is a perfect storm of problems
No,
there.
there's a law, so they just like super tall to be have coverage in a normal coverage for vehicle damage, or somebody riding a bike, if you're not, let's say, effectively maintaining the condition of your parking lot.
A bike would be different because that's no longer an auto, but if they're injured or if they try to sue you for the damage to their bike, I doubt that would even breach your deductible.
Okay.
But
And plus, if they don't live there, it's private property, so they shouldn't have been on their property.
No, yes, I was just asking, just like if you did.
Well, and
if you
every-
did that in a mall
every
parking lot
claim
or-
scenario, I'll tell you this, every claim scenario is different. It's impossible for me to tell you the outcome of every type of claim.
Okay,
There's a lot of
if it was
factors,
standard,
negligence.
So it's not.
If again, if they had to defend you or pay that claim, your policy would have coverage if you were sued for that,
Right.
for example.
But we could have just had the parking lot done, which we did. Winter comes, the plow makes it go away, what we just had fixed.
I just wondered if they had. coverage.
reasonable
So there's gotta be like,
expectations,
we can furniture
Just a subject.
that we just had it all
We would
redone,
defend you in
but
that instance,
the
yes.
plow doing the snow made it not good anymore.
It's surprising how frivolous the claims are
And
that
then we
I've
show
seen.
that we did have it all fixed.
I had someone slip on a pop can in the parking lot and sue the association.
Did they
Which
win?
things, because some are legitimate.
I'll tell you, I'll have to check on that.
Okay.
I can't, again, open and obvious loss. I can't imagine
Right.
that you could be held responsible for a Coke can. The only thing that I will just, in all honesty, will tell you is a lot of times they get settled because it's cheaper for you and the insurance company if they give them $1,000 and walk away.
Mhm. You're right.
Attorneys are very expensive. Anybody else?
33% of the thousands now.
Are you gonna?
Right, no, it's not.
Are you gonna bring up terrorism, insurance?
I am not talking about terrorism. What question do you have on it?
Do you suggest that we have that, policy?
It's standard, and so most standard carriers automatically include terrorism coverage.
Yeah,
So, I mean, yes, of course, we hope that there's never that issue, but
I mean, it's not that much, and when we renew, they
Usually
ask for
$100
to drop it or something, and I'm like,
yeah,
I don't know.
I would keep terrorism coverage on your policy. If something does happen and there's a large loss to your community, you would no longer have a community if you don't have that coverage.
Right.
So yes, I would recommend keeping it.
Keeping it, okay.
I do have one last question on that.
Sure.
All right, say you're an association that's hard up to fix some of the issues that you have, say that with roads, with concrete on the property, and someone gets damage to their car or there's personal injury or something, in the area where, it should be fixed or should have been fixed, but you haven't been able to because you didn't have the financial capability. How is that?
Because you didn't have the financial capability or because you just
You didn't have the finances to do it.
So again, this is a very specific scenario, and they would have to investigate the entire situation to find out if there was any fault. But
In
if,
other words, it's not, would it be considered negligence because you couldn't afford to have it fixed?
I don't want to answer that yes or no. And I would have to, you would have to file that claim and let them kind of duke out the
Let's see what
details.
happens. Okay.
Yes, you'd be defended, whether it be a director, saying the board didn't do their job well, you have your directors and officers liability, or the liability or the property damage would fall on your general liability policy. So either way, you would at least be defended, but I don't
Defendant
want to.
isn't paying the claim though.
Hmm?
So if you lose, insurance doesn't pay the claim, right? You just pay the defense.
Yeah, I mean, what do you mean? Someone's
If
like
somebody
hurt?
sues the HOA for whatever reason, and let's say it has to do with responsibility of the directors and officers. If you lost that claim, the
They
HOA
pay
pays for the defense,
They pay
but
the
do they pay
lawsuit.
for the award also?
The lawsuit?
Yeah, if you
Of
lost the
course.
lawsuit, had to pay $2 million,
Sure.
insurance pays that.
Yeah, whether you're deemed,
If you're at
Yes.
fault.
yeah,
Okay.
I mean, whether you're negligent, found to be negligent or not negligent, that policy is there for you, yes. And that's why, so we're gonna get into the D&O specifically, but that's why it is so important in that D&O coverage that you not only have your $1 million limit, but maybe you have that additional $1 million defense limit and you have your umbrella. So you have layers of protection if it is a $2 million.
And is to make sure that someone's not inadequately doing their job that could cause a lawsuit.
So crime coverage is gonna protect the association against loss of funds. So that's gonna be like an employee theft. So let's say your treasurer's been not paying bills for the last 3 years. And then they've been pocketing that money and it adds up to $100,000. That's gonna be your fidelity coverage. It's gonna be protecting the association against theft by the employees or the board. So that's to protect, so if someone running off with the entire reserve fund, for example.
That's why you hired KS to take care of financial.
And then they have to do.
Good sales plug.
But we are gonna talk about crime too, so, give me just a few minutes on that. So workers' compensation, I do wanna talk about this. A lot of associations struggle with, why am I carrying a work comp policy if I don't have employees and the board's not covered on it? Well, you have the chance of uninsured subcontractors, and you also have the chance of volunteers in your community doing planting flower beds, doing things for the association beyond what is part of their unit. And if a lawsuit did arise because someone is hurt in that situation, the workers' compensation policy could kick in. So that's gonna be any type of lawsuit stemming from that would be covered under that policy. The big one here for me is uninsured subcontractors. So you've got your landscaping guys out there and one of them is severely injured and they don't
But
have.
again,
they
they
don't
can
care.
show you they are, and
Correct.
it's not actually the.
Correct, and that is why, so when I say uninsured subcontractor, you should never hire anyone that's uninsured. You should be making sure they're insured, but if that certificate is fraudulent, if that certificate has expired, if that policy canceled because they didn't pay it, you would still want to have that coverage as backup. So it's a fail safe. And it's $550 a year or $525. I knew I'd get there. $575 a year. You don't have to deal with an audit with the specific carrier, PMA, unusual. So it's worth your time and that very inexpensive amount of money to protect yourself in that type of situation.
And worth your property manager stay.
Yes. And again, so depending on the type of policy, we usually have C2, one through the placement facility. There are other carriers out there as well. One through the placement facility, which will not cover volunteers. And then there's an option through Penn Mutual that I just mentioned that we use specifically that will cover your volunteers. So it's important to ask when you are receiving this coverage if it's going to cover your volunteers or if it's just for those uninsured subcontractors. And obviously, if you have a full-time employee, you should have them listed on that policy and pay for their payroll. Any questions on the work comp? Okay, so directors and officers coverage. So actual or alleged wrongful acts in managing the association. So to your question, it could be an actual act that you performed and caused the damage, or it could just be an alleged wrongful act. So this could be misuse of funds or assets, failure to adhere to your bylaws. Hopefully your policy includes discrimination or harassment, which we call employment practices liability, tenant discrimination, or third-party harassment and discrimination. Depending on the coverage that you have and the carrier that you have, that may or may not be included. So that's a good question to ask is, do we have discrimination or harassment, or if you want to just call it EPLI, employment practices liability. And then failure to provide security would be included in that as well. So again, failure, the one I see most, or the one I'll use as my example tonight, is COVID. Okay, COVID caused waves through all of condominium associations, directors and officers liability policies. Because do we open the pool, do we not open the pool? Do we open the clubhouse, do we not open the clubhouse? And I can tell you I have seen a claim because the association didn't open the clubhouse, and I have seen a claim because the association did open the clubhouse. And of course, if you're following all of the rules in legislature and what your bylaws dictate, then you should be all set. But if you aren't, for any reason, that policy would have covered you for that. Again, it's not contracting COVID, but the specific error in opening or not opening the clubhouse. Making sure again that your policy has an additional limit of defense. So the most expensive part of the policy is typically the defense. Hopefully you didn't actually do the wrongful act and we're just paying for your defense. But keep in mind that if you have a policy that has $1 million limit, it's very likely including defense costs and any settlement. You'll want to make sure that your policy includes full prior acts and includes the property management company as an additional insured in case they perform any negligent acts on your behalf. Another important factor is all past, future, and present board members and spouses. So if a prior board to you did a wrongful act or did things out, maybe they elected an official without using the proper protocols and bylaws, and they were sued, they would still have coverage on the policy. Now, again, something to look out for in your policy and to make sure that your policy covers that, because every carrier is different. So we specifically use travelers, and they do cover all of these items. So.
When you make a big claim, is it like your car? As soon as it pays out, your insurance rates going out?
A large D&O claim is definitely going to make your insurance rates go up. A small wrongful act claim where just defense was paid out, I would guess there's always going to be a small increase, but not likely a large increase. And this the traveler's policy is also non-cancelable by the insurer. So let's say you did have a so another thing to look at.
For any reason? Even if you don't pay?
Well, if you don't pay and eventually the policy cancels, but they can't. Well, they still, yeah, they can't cancel you just flat.
Consistency.
We're going to talk about two types, very specific types that I think are important of directors and officers coverage and how the policies work. So there's occurrence coverage and there's claims made coverage. So I included examples of both because this can get very complicated very quickly on understanding the two types of coverage. Occurrence coverage has lifetime protection during the policy period, and in most cases will include full prior acts or continual coverage. So if you have an occurrence policy and you've had it for 10 years, you've been protected for a lifetime for each policy period by that insurance company. So if you had Farm Bureau directors and officers coverage for a year and it was occurrence based, and then you had Travelers, and then you had Hartford, whatever date the loss occurred, it would depend on which policy responded. But that policy has to respond indefinitely on an occurrence-based policy
That took place when you became under.
during the policy period.
So if you switched insurance companies to a new company for 10 years ago, but then a lawsuit came up
From
that
10 years ago.
wrote in 10 years ago, that insurance company is still responsible for that period of time?
Correct. So in this example, so your policy period started in January of 2016, and the loss occurred during the policy period, but the claim was reported outside of it. Since the incident occurred within the policy period, it's still eligible for coverage. So, for example, if the association no longer existed after December of 2016 and the claim was reported, you would still be covered during that policy period. Alternate would be claims made policy. So there's only coverage on this policy if you file a claim during the policy period within your retroactive date or your extended period. So if you look at the timeline here, your retroactive date is going to be the first date that you purchased coverage. Okay, then you're going to have a policy period. So if the claim happened prior to the policy period, but wasn't reported until the policy period, you would have coverage because it's within that very top retroactive date. If it was filed, or if it happened before the retroactive date, but it was filed during your policy period, you would not have coverage. So the second, or adversely, let's say in that same scenario I just said, December of 2016, the condominium association no longer exists. You're not part of the board anymore. It dissolved, okay? You would have on this policy likely an extended reporting period. Typically, again, it's about 180 days. You can extend it a year, whatever you'd like to do there. They offer different terms. If the claim is within the extended report, if reported during the extended reporting period, it would still be covered. However, the second that period ends, coverage is gone. You never have coverage again. So for this type of policy specifically, we say that occurrence-based policies are best because you have coverage for a lifetime. And the second that you are done with that business or that association, and you no longer have coverage, it doesn't matter because the entire time you were operational, you had coverage with that carrier.
Occurrence-based.
With full prior acts.
Christy, can you jump back for a second?
Sure.
So Tony asked why for D&O coverage, why you would want your spouse to have coverage?
So it's personal liability. So if you have a spouse, they're held personally liable, just like you would be held personally liable as an officer of the board. So your spouse would have the same coverage as you in a lawsuit, so that when you're sued personally, you're both covered.
I've seen, there's another instance where I've seen where like maybe you discuss something with your spouse that's privileged board information. And your spouse then goes around the community and talks about something that they should know about. It would
Absolutely.
cover them in that case.
Yes,
That's something
that's
I've seen.
another, that's a great example. Yes. Yes.
But then we only get one vote, so we can go, you know.
Yeah, it would be like liability.
Like
No, but like, I mean, I
defamation
know
of
we're
character.
talking about a vote, but it's either he or I vote when we do votes, so.
So think defamation. Think I told you privileged information about a unit owner or someone in the community, and then you went and spread that information to other people and defamed that person.
Well, the board member, yeah, talking to other people,
No, the spouse.
so what's the spouse have to do? I don't see.
So the board member talked to the spouse about, I have an
I
example.
know
I
what
can
you're
give you.
saying, but
So I have a good example that I can give you.
Okay.
So let's say the board member comes home and after the board meeting and tells his wife, Susie in unit 101 hasn't paid her dues in so many months. Then wife is friends with someone who lives in unit 202 and starts gossiping about, Susie who's in 101, oh, I found out she hasn't paid her dues, and so they're giving information that they shouldn't have to somebody else within the community. And then Susie in 101 then sues the board because she, there's information out there about her, and then it spreads through the whole community, things like that. That's why it's just protecting them together as if they were both on the board. Does that make sense?
Yeah, okay, what if I tell my son something?
Only if he blabs it, only if he blabs it, and only if somebody brings it,
So
and it's
what,
only if somebody brings it.
so my son lives in my home also, and he overhears me telling my husband something.
What's the liability if you're not covered for that?
You would not be, I mean, I guess he could be
Then we
personally,
wouldn't be covered, because that's what I'm like wondering.
he
Does that
could,
mean
maybe he could
the
be
insurance
personally
company
sued.
wouldn't cover her because she said something she wasn't supposed to say?
The directors and officers coverage would not cover her for things her son said about someone else. Correct. The code of silence.
Exactly, good answer.
I could see in that situation, if she sued the son for defamation of character, possibly his personal liability extending to him, but the directors and officers policy would not.
Would not cover.
Okay, crime coverage, so fidelity bonds being the most prevalent or important piece of this. We call it employee dishonesty, we call it fidelity, we call it a fidelity bond, we call it employee fidelity, there's many names, but it's employee theft of association funds or assets from the company, or from the association, excuse me. So you should always have coverage for, at any given moment, the total amount that the association would have, excuse me. The basic or our determining factor for us is what the FHA requirements are, which is 3 months of dues plus the reserve fund. So whatever's in your reserve fund plus 3 months of dues. And then again, what do your bylaws say or require you to carry? I've seen it more and more that the bylaws have this 3 months of dues plus the reserve fund listed in there. It doesn't mean necessarily that you don't need more than what your bylaws say. However, there is ramifications for, of course, keeping your bylaws, keeping up with your bylaws and making sure that you're following what they say. In crime coverage, there are other pieces as well. There's forgery or alteration, computer fraud, including social engineering, and funds transfer frauds. So I'll talk about social engineering specifically because this is, again, something that we've seen very often. So social engineering is specifically someone pretending, so let's say via email, they're pretending to be, let's say, the president of the board. Maybe only the president of the board has the authority to issue funds, okay? And you get an email that looks like, sounds like, seems like it's from the president of the board telling you to make a payment of a bill transaction. And you have to do this immediately or they're going to turn off the power to the entire association. Now, you pay that bill. It was a fraudulent claim, that's what we would consider a social engineering claim, and that policy would cover that type of loss. If you have social engineering coverage, so important coverage item that you should carry. Forgery or alteration, again, that's a forgery or an alteration that you try to, let's say, cash, and then you have fees associated with that forgery or alteration that you try to cash into your association funds. Same thing with money or counterfeit money, money orders, excuse me, or counterfeit money that you try to deposit into the account, unaware, of course, that it's counterfeit. And funds transfer fraud becoming more and more prevalent. Any type, let's say someone gets into your system and takes a funds transfer to their bank account overseas. there would be coverage on the crime policy to replace those funds. So very important with crime coverage that you have proper controls in place as an association. The three most important that are number one, gonna protect you, and number two, get you cheaper insurance premiums are gonna be counter signature. So you don't have just one person that's allowed to sign checks, you require that two people sign checks. Segregation of duties, so if one person is signing checks or two people, someone else has to do the deposits and someone else has to do the withdrawals. So then you never have one person handling all funds at the same time. And then of course, CPA audits or CPA reviews, someone that's reviewing the funds quarterly, monthly, to make sure that what's going in and out is what is supposed to be going in and out. That bills are being paid appropriately, and that no one is sneaking funds away in a very small manner. So the example again that I always give with this is a board member slowly taking money over time in very small increments for many years that maybe snuck through the books because there were no controls in place to stop him from withdrawing money. So maybe every time he withdrew $1,500, he took $1,520. Eventually that adds up. Any questions on that? I know we kind of already talked about fidelity and bonds. Anything to add to the crime or fidelity? Any questions? I know. It's a ton of information, and that was just 101. So.
I was gonna ask you early on, let me ask now.
Yes.
Do you have literature that kind of helps to back this up a little bit available or not?
We have some in relation to specific policies like the directors and officers and crime policies. There are kind of like checklists or cheat sheets on what the coverage is and what like claims examples.
Yeah.
So that's probably something that would be beneficial for you to have just so that you understand the coverage and you can see it in front of you.
Yeah.
Other than that, it's really policy language and understanding declarations pages.
Which most of us wouldn't understand.
Right, and having a great property manager and agent to explain that coverage to you on a more in-depth basis.
Mm-hmm.
So for example, for all of you, if you wanted us to come out specifically to your community and give a similar type presentation that's specific to your community, we're more than happy to do that for you. And it may be even more beneficial than just insurance jargon for the time being. But this is a great basis for you guys to start to understand the different types of coverage and nuances that occur.
So if we are, like, we used to handle our finances and we did have two people have to sign checks and blah, blah, blah. Now that we fired Chaos to take care of all our finances. So is this something on our coverage insurance that we could drop now?
No, because you could still be held liable for your crime as the association. Now, they carry their own crime coverage separately, but that doesn't completely eliminate any liability that you have as an association.
Okay.
So you would still.
We're not handling any of the money, nothing, writing checks, nothing.
Correct.
Right, because that's a perfect world.
Because your policy might include them as additional insured, but their policy doesn't include every association as additional insured.
That would be a crime.
And it could be an instance, kind of like what she said with the social engineering, like maybe we get an email from someone claiming to be the board president and they hacked an email and we release a check, it would still cover that.
Gotcha. Okay.
And Dick, to answer your question, there's Arcadian.
There is.
I feel like I may have stolen this from Farm Bureau because it's in the same order, general liability, workers' comp, D&O, then fidelity. But we have literature as well internally, through like CAI, the governing body for condos,
Let me look
and stuff, depending on where you're located, we can have some stuff as well. No, is there anyone, you guys have all been quiet on Zoom, is there anyone that has anything on there, anyone want to unmute or type anything in the chat?
Do you have business cards?
We do, yes, they are right up front here,
Okay.
and feel free to grab some on the way out. You'll be working with Amy, on any submissions that you have or questions. And she's fantastic, she knows just as much as me.
Look at our current policy and advise on what you would improve, or maybe even explain, oh, guess what, this means you're not covered for this and this.
Sure.
To, provide, I'm sure, a comparison to how you would be a benefit over something else or your coverage, is that something that you do, like in the?
Oh, absolutely, in every quote that we do, or if you just wanted a review, we could give a comparison spreadsheet of this is what you have today, this is what the policies would offer.
I like that, because sometimes it's similar to people shopping around for mortgages. They go, I'm going with this one, it's the cheapest rate, but they don't explain, well, that's because I'm charging you points on the other side. And your origination fee is higher for the interest rate, blah, blah, blah. So you could do that and help
Absolutely.
us realize what's not covered
Mhm.
or what might be outdated or might be
The
needed.
bylaws need to be updated first.
Right.
Yes, so we could
Just wanted to know.
definitely review and advise if there was coverage items that we would recommend or increasing, or that maybe you should take a look at this part of your policy.
Thank you.
Of course.
Do you guys do anything with bylaws or no?
As far as like rewriting,
Uh-huh.
no, we do not.
They'll look at, for the association coverage, that's how they'll build the policy, is they'll look
Right,
at
do the
that.
bylaws.
And they'll advise on, in some instances, what co-owner should have, because they write co-owner policies sometimes as well, HO6 policies. But that's where.
Even sure where increased risks and liabilities are in the bylaws that we have that may cause their insurance to be some high.
Just read that, you don't mind.
Yes,
But you could say, well, this is why we're showing it, because of this clause and that clause and that.
So I have a question.
Liability.
The lawyer you had at the Zoom last week. When we had to file our bar and all that, you had us go to a different one?
Okay.
So which one would you suggest? Cause we need to get our bylaws redone.
Well, I'll have that conversation with you separately.
Cause, you referred the other guy, but,
Yeah, there's a few, same with like insurance, there's several different carriers that we work with, and they're all, our job as a management company is always to provide the boards with options and say, hey, here's 3 good people. You guys can interview them, see who you like
Right.
the best, look at
Word of
pricing.
mouth.
Of course.
well, that was one of you guys had referred, and then this guy, I really liked this guy on Zoom last week, so. We like the other place too, don't get me wrong, they're both in Farmington, so it's still a drive, but,
Yeah, I'll get with you separately, yeah.
okay.
Alright, well, thank you.
The cheapest.
Appreciate you guys listening and all the questions.
Great presentation, and
Thank
thank you for providing the.
Yeah, thank you.
Thank you.
And the popcorn was,
I stayed up all night baking the popcorn.
Yeah, okay.
What awesome packaging.
Right?
Alright, great.
If, and if any of you guys have any feedback for